Welcome guys to a new video. In this lesson we're going to cover something very important and highly demanded, which is how to determine the bias. So by the bias I mean the next move of the market or the direction. Alright, the bias is not limited to the daily bias, so don't get confused. It can be the weekly bias, it can be the daily bias, it can be the hourly bias. So the things I'm gonna show you today is you can apply it on any time frame to determine the next move of the market, including the daily time frame. So the strategy that I'm gonna show you today to determine the bias is a combination of two concepts I have introduced and showed you before on my channel. So we have this video right here, high and low resistance liquidity, plus we have this video talking about what does the market do. So these two videos, the two concepts that I have showed you here, we're gonna merge them together and we're gonna come out with a strategy to determine the bias easily. Now each one of them is can be used to determine the bias. Combining them together will make you unstoppable, guys. So the structure of this video is going to be as follows. First of all, I'm going to explain each one of these two concepts briefly. So if you want more details, you can go and check these two videos. I'm going to link them on the description. So I'm going to explain each one of them briefly, and then I'm going to show you how to merge them together. All right, guys. And then I'm going to show you live chart examples, which is the most important part. And you can see how applying them together on the chart can give you a high probability bias. All right. So without any further ado, let's just get started. So the first concept, which is high resistance liquidity and low resistance liquidity. So what basically this means is I'm gonna show you by visual representation, so you can guys see clearly what I'm talking about. So let's start with low resistance liquidity. Low resistance liquidity is like this. So you see this move right here. You see this failed swings. This failed swings. So this swing couldn't penetrate or take liquidity above the swing. This one also. So this failed swings represent low resistance. Why it is low resistance? Because price will always seek for liquidity. All right, guys. So you can see that liquidity here has never been touched. So the price will see this as a target, and it will attack them in an explosive way. So this is called low resistance liquidity. All right, guys. When you see failed swings like this is called a low resistance liquidity. It can be also like this. So price is forming equal highs. All right. So this is also called low resistance liquidity. High resistance liquidity is like this. Let's see a move. You can see the difference between them. So this is high resistance. Why? You can see price after forming this swing, immediately after take liquidity from this swing and rejects. So this is called high resistance liquidity. Why? Because price will have problems to go to this one, because this swing already took liquidity. All right, guys. Another one here. So this swing right here, price took liquidity from it and then rejects. So when price takes liquidity from another swing, a previous swing, and then rejects immediately, that's called high resistance liquidity. So the price is gonna face resistance, high resistance, to reach to this swing right here, because we have already taken liquidity. And usually after creating this kind of move right here, so after taking liquidity and then rejecting, you will see there is PD arrays right here, like a fair value gap, an order block, a breaker, maybe an inverted fair value gap. So price has to breach all those PD arrays to go to this swing right here. Now keep this in mind, and I'm going to show you exactly how to use this to determine the bias. Now this is the first concept. The second concept that we're going to cover, and we're going to merge with this one, is called external and internal range liquidity. Again, I'm going to explain it briefly. So if you want more details, you can go to my previous video. Now moving on to the second concept, and you can see from this example right here. So this is internal and external range liquidity. Basically, internal range liquidity is fair value gaps. Keep in mind, internal range liquidity are fair value gaps. External range liquidity are these swings right here. So swing is called external range liquidity. Now the market will only seek liquidity or balance and imbalance. All right, keep this in mind. The market will only do two things. It will either seek for liquidity or a balance and imbalance. All right, guys. So internal and external liquidity, price basically will move like this. It will attack external liquidity, and then to internal range liquidity with fair value gap, then targeting external liquidity, and then retracing to internal range liquidity, and then external. So the market moves this way. It will move from internal to external, from external to internal range liquidity. All right, guys. So this is the second concept. Again, if you want more details, go to my previous video. Now, high resistance liquidity and low resistance liquidity, merging them together with internal and external range liquidity. How we can determine the next direction of the market based on these two concepts. Stay with me with live chart examples. And guys, take notes. You want to take notes watching this. Now, starting with the first example, and this is the Dixie. All right, this is the 4-hour chart of the Dixie. Again, you can apply this concepts on any time frame. It doesn't matter. Now, I hope you took notes when I explained the two concepts earlier. Now let's apply these two concepts on this piece of price action right here. Now, what we have learned from the first concept, which is high resistance and low resistance liquidity, is that price is likely to attack engineered liquidity, which is filled swings, which is low resistance liquidity. All right. While a high resistance liquidity is price is unlikely to go there because it already took liquidity from there. All right. So that's the first concept. That's a lesson we learned from the first concept. Now, the second concept is we learned that price moves from external range liquidity, which is highs, which is swings, swing lows and swing highs, and then moves to internal range liquidity. And then from internal range liquidity, then external range liquidity. All right, guys. Now let's apply these two lessons on this on this piece of price action. Now, I opened the chart here. All right. So I'm here. All right. Now, what do we do here? We attacked this external range liquidity. All right, guys. And we created high resistance liquidity. So you can see that we attacked this external range liquidity and then rejects immediately. So this become external range liquidity. So on the buy side, we have took external range liquidity, plus we have created a high resistance liquidity environment. All right. Now, what do we have on the sell side? We have internal range liquidity. So after taking external range liquidity, the next thing we want to do is taking internal range liquidity. So so this is from the second concept, and the first concept we have these swings right here. So you can see this candle right here, and this one and this one. These are swings. It doesn't look like swing because swing is a 3-candle formation, but we are on the 4-hour chart. If we go to the 15-minute chart or the 1 hour, so this represents a swing. As you can see, they are failed swings, meaning they are low resistance liquidity on, and price likes these levels, which is low resistance liquidity, these failed swings, because there are liquidity below them. All right, guys. So we have two confluences. We have internal liquidity, plus we have lower resistance liquidity run. So it is only logic that price will come here. Now, when I say that I am favoring this offer, this areas right here, I am talking in probability. So there is like 70 or 80% chance of going here, but there's always a chance of prices keeps going higher. So I need to think in probabilities rather than certainty. And as you can see, price explosive move to the downside. All right, now what do we have here? Price takes this lowers this liquidity and then hit this internal range liquidity. Now how do you determine the next move from here? What do we have here? This swing and this swing. If you go to 15-minute chart or the 5-minute, you can see this is low resistance liquidity because we have filled swings right here, plus we have created a high resistance liquidity on the downside. And what is this? This is external range liquidity. All right, so the next move is only logical to move here. And as you can see, price attacked this external range liquidity and creating a high resistance liquidity here. So you can see that price took external liquidity from here, took this swing and then rejects immediately. So the price from here is unlikely to go all the way from here. All right, let's look at the second example. The second example is EURUSD. All right, so this is the 15-minute chart. Now try to apply these two concepts together on this piece of price action. So this one right here is this green rectangle is for our fair value gap. So this internal range liquidity. So price attacked internal range liquidity, leaving behind what? External range liquidity. Now from the high resistance and low resistance liquidity concept, you can see that price is leaving low resistance liquidity right here. Plus we are creating a high resistance liquidity on the sell side. So combining these two concepts together, we can expect a move to the upside, and you can see price exploded to the upside. Let's look at the third example. So price took external range liquidity right here, plus it bounced this fair value gap right here. Now do we have so we are creating a high resistance liquidity, all right, and we took external range liquidity on the sell side, plus we took internal range liquidity from here. So on the sell side, we have done the two things, all right, creating high resistance liquidity and balancing an imbalance and attacking an external range liquidity. Now what do we have on the buy side? We have this filled swings right here. All right, guys. So price attacks it and then rejects. So after taking external liquidity, the next thing is what? Retracing to internal range liquidity. We have another example right here. This is the US dollar again index. So we took external liquidity, and this equal lows are on this is a higher time frame equal lows. All right, so taking external liquidity plus creating high resistance liquidity on the sell side. And what do we have here? We have fair value gaps. So we have internal range liquidity on the buy side, plus what do we have here? Failed swings, which is low resistance liquidity. Price and then price immediately explodes to the upside. Let's see if we have another example. And of course, so this move right here on the Dixie, on the US dollar index, after I predicted that, I have come with a conclusion that we might see a down move right here. I went to EURUSD and I had a confluence that the market was going up. So if the Dixie is going down, then you want to long EURUSD. So this gave me a confluence. I didn't need to look at the higher time frame on EURUSD. I just look at the higher time frame on the Dixie and then traded this move right here. So this was our lesson for today. If you guys liked my video, I appreciate if you subscribe to my channel and hit that like button. If you have any questions, DM me on my Twitter account or leave a comment down below and I'll answer you. And happy trading and good luck.